All right, let's dive in. Today, we are going to pull back the curtain on one of the most common starting points for any new investor, mutual funds. Our goal is simple, to give you a clear map so you can navigate this world with a whole lot more confidence. Let's get this journey started. Have you ever looked at all the investment options out there and just felt completely lost? Like you're staring at a map written in a language you don't understand? Well, you're definitely not alone. All the jargon, the endless choices, yeah, it can be pretty overwhelming. But that's exactly why we're here. Think of this explainer as your personal map and compass. We're going to break down what mutual funds are step by step so you can feel ready to explore this landscape on your own terms. So every great journey starts with a first step, right? For us, that first step is understanding the vehicle we're going to be using for this trip, the mutual fund itself. So what is a mutual fund, really? Imagine you and a bunch of other travelers decide to pool your money to hire an expert local guide. That's pretty much it. A mutual fund pools money from lots of different investors, and then a professional fund manager takes that money and invests it in a whole variety of assets. It's a way to get instantly diversified without having to go out and pick every single stock or bond yourself. Okay, now that we've got our vehicle, let's take a look at the map of the world. Thankfully, we don't have to wander aimlessly. India's regulator, SEBI, has already organized the entire mutual fund universe into a few main categories to make things simpler. And here they are, the 5 main continents on our investment map. Now, while they all have their own unique features, most investors usually start their journey in one of 3 main areas: equity, debt, and hybrid funds. So let's zoom in on those. It's actually pretty straightforward when you break it down. Equity funds invest in company stocks. Think of this as the path for long-term growth. Debt funds are a bit more conservative. They invest in things like bonds, aiming for more stable returns. And hybrid funds? Well, they're a mix of both. The right one for you really just depends on your final destination. Are you aiming for high growth, steady income, or a balance of the two? Let's explore that first continent a little more: equity. See, when you invest in stocks, you're not just buying into companies in general, you're buying into companies of very different sizes, and that distinction is super important. So, how do we actually measure how big a company is? We use something called market capitalization, or just market cap for short. It's simply the price of one share multiplied by the total number of shares out there. This one number tells us if we're dealing with a huge established giant or a small, scrappy up-and-comer. And this table really lays out the trade-offs. Large cap funds invest in those huge, well-known companies. Think of them as the big, stable capital cities on our map, usually lower risk but maybe with slower growth. Mid-caps are the growing cities, and small caps are those exciting new towns with tons of potential. But here's the key. With that higher growth potential, almost always comes higher risk. And that brings us to a really crucial point. If you're drawn to that exciting high-growth path of small-cap funds, you have to be comfortable with the bumps along the road. So the big question is, how do you actually measure that risk before you put your money down? Well, this is where your compass comes in handy. SEBI has made it mandatory. Every single mutual fund has to display this simple, standardized tool called the riskometer. It's designed to give you an instant, easy-to-read snapshot of a fund's risk level. And the best part is, it's designed to be incredibly simple. The riskometer has 6 color-coded levels, from low risk all the way up to very high risk. So before you invest a single rupee, you can just glance at this and see if the fund's risk level actually matches your own personal comfort zone. It's an absolutely essential checkpoint on your journey. All right, our next decision point on this journey is about the type of road you want to travel on. Is it going to be an open highway with lots of on-ramps and exits, or more like a fixed train track that goes to a single destination? That's the core difference between open-ended and closed-ended funds. It really all comes down to flexibility. Open-ended funds are like that open highway. You can buy or sell your units pretty much whenever you want. This is why they're the most common type. Closed-ended funds, on the other hand, are more like that train. You can only get on board during a specific window, and then your money is locked in for a set amount of time. It gives the fund manager more stability, but you give up that freedom to get out anytime. Okay, we've covered the map, the compass, and the type of road. For our final stop, let's look at a tool for the really smart traveler, a way to pop the hood and see what's really going on inside your fund. This tool is called the Portfolio Turnover Ratio. In simple terms, it just tells you how active the fund manager is. Are they constantly buying and selling things, tweaking their portfolio?
Or are they following a more long-term buy and hold kind of strategy?
And why should you care? Well, a really high turnover can lead to higher transaction costs, which you, the investor, ultimately pay for. It can also create more tax events. A low turnover, on the other hand, usually signals that the manager is making confident, long-term bets. It's a great little insight into the fund's core philosophy. So let's quickly recap our traveler's checklist. First, know the main fund types: equity, debt, or hybrid, and pick the one that fits your destination. Second, understand company size: large, mid, or small cap, to get the right balance of risk and growth. And third, always use your tools. Check that riskometer to match your comfort level and know whether you're on an open or a closed road.
We have covered a ton of ground today, and now you are equipped with the fundamental tools to start navigating the world of mutual funds. The landscape is huge, yes, but it's not impossible to map out. The only real question left is, with this map and compass in your hand, where do you want to go first?